Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. I'm your host, Dr. Alan, and I'm excited to explore the big question we all ask, and that is it time to buy or is it time to sell? Kathy Fettke is a real estate investor, podcaster, and owner of RealWealth Network, an investor group with over 60,000 members worldwide. She simplifies the complicated world of real estate investing to help more people build cash-flowing rental properties. She is passionate about researching real estate market cycles, demographic shifts, and areas of job and population growth, so that helps her investors acquire or dispose of property in the right place at the right time. Kathy is the author of the #1 bestseller, Retire Rich with Rentals, and is a frequent guest expert on such media as CNN, CNBC, Fox News, NPR, and CBS MarketWatch. Kathy, share with us a memorable experience from your formative years that helped you to be who you are today.
Such a good question. When I was growing up, which was a long, long time ago, women were not generally very involved in the financial affairs of the family. And so when I remember my mother would sit at the dinner table and say, Doug, we should buy some of these little homes and rent them out. And he would say, oh, Barbara, who's going to watch them? And, who's going to take care of them? And I don't want to fix toilets. And well, those little $50,000 homes in Menlo Park, California are, $5 million minimum today. So I could have been a very rich and spoiled trust fund kid had my mother been more involved in the financial affairs of our family. Ironically, my dad made a great income. He just didn't always choose the best investments, but the one investment he chose was, to pay off the home that they lived in. And that is really what got my mother through the final years of her life, 20 years. She was able to live comfortably in retirement because of the house that they had that she had then sold, downsized, and lived off that money. So, a few things came from that is just wanting to be more involved in the financial affairs of my family and to obviously invest in properties that are worth a whole lot more over time.
Yeah, well, that's one thing you can count on real estate. It's going to have its ups and downs, but overall, it is always going to go up. Well, Barbara, we're so glad to have you with us today, and you really are not all that old. Just wait till you get to my age, then you can talk about being old. But we have seen some changes in gender roles in our lifetimes, that is for certain, and I think that's very good. So tell us about prices. They are at their all-time highs, but that doesn't mean that that's where they're going to stay or that is going to be the high watermark 10 years from now. So what's going to continue here?
Well, it's really funny. Everybody's got an opinion about it, right? I was just doing home inspections today on a house that we're buying. And the inspector was like, why would you be buying a house at this time? I don't think he was supposed to be talking like this. But he's like, this is 2006 all over again. It's going to crash. It's going to be 10 years before values come back. And I think a lot of people do feel that way. We normally have a real estate crash about every 10 years somewhere and or some kind of economic downturn. So one would think based on that there might be that, we've hit all-time highs. People are making crazy multiple offers. There's multifamily that are trading for twice what they did just 18 months ago. That sounds like a bubble, right? But when you kind of look further into what's going on, we have never, at least in the history of America that I know, we have never created this much cash. It's like we're sitting around the table playing Monopoly and everybody's got their money and they're buying and trading the little houses and the little apartment buildings on the board. And then somebody comes in and brings in another bucket of money and then another bucket of money. And all of a sudden you've got more money on the table, but the number of assets on the board game are the same. So what happens? People just pay more. They have more money. And it's all fake money, right? In the monopoly game, it's just pieces of paper, but that's not that different to what has happened over the past 10 years. The amount of money circulating through just digital, the Fed being able to digitally increase the money supply is unprecedented. So it's not really as if values have gone up so much as the value dollar has gone down. It takes more of those little pieces of paper to buy the same thing that you could buy a year ago, or 2 years ago. So we are realizing inflation is not transitory. It is here, because the fact of the matter is, when you pour that much money into a system where there's the same number of assets, you're going to see it. So, we see builders trying to bring on new supply. They're having a hard time. There's supply chain issues. There's boats still outside Long Beach waiting to be unloaded. Builders cannot, we're in the building industry too, and it's very difficult to get all the things you need to get your final CO and be able to sell the house. So the supply is trying to increase, but it's very slow. It's behind. And but at the same time, we have all this money, in addition to two very large generations looking for a place to live. You have millennials, who are the largest cohort of millennials is 29 years old. And they are right before home buying age. They are investing. They're circulating that money. A lot of them are high income earners. Then you've got the Gen Z generation, the younger ones, moving out of college and forming households and living in apartments. So massive demand. The baby boomers aren't dying off as quickly as I guess some of the economists thought they would. We're living longer, staying put. So there is a tremendous demand for housing, not enough of it either to rent or to buy. And so, no, I don't see a housing crash coming anytime soon.
That's what I hear from many experts. It's hard to believe, but when you look at it from a supply side issue, you begin to understand that it is going to be difficult to crash because the demand is so high and the supply has just not been keeping up with that demand.
Yeah.
So in this time of low cap rates and extreme competition, where do you go to find deals, particularly deals that are going to cash flow from the get-go?
Boy, it's tough these days. You've got to maybe change your underwriting guidelines. The cash flow is not what it was last year or the year before, and certainly not what it was in 2009 or 2010 if you were lucky enough to acquire at that time. Prices were low, interest rates were low, and rents were pretty high. Rents stayed high along throughout the Great Recession. So what we used to look for, which was 20% returns back then, it kind of went down to 15, then 12, then 9 and 8 and 6. I mean, returns are decreasing in terms of cash flow, but in equity growth, that's really taken off, right? So you just really have to look at, why am I buying real estate today? And what we know, without a doubt, is that real estate really performs in an inflationary environment, especially and mainly if you borrow the money. If you're locking in low cost debt, debt that's almost free, right? You can get a 30-year loan, a loan you don't have to pay off for 3 decades, and get these locked fixed rates. If you want, you can also get adjustable, but if you want the fixed rate for 30 years, yet we know that we have an inflation, so rents will most likely go up over a 30-year time period. That is how you create massive wealth. When you're borrowing someone else's money at low cost money, acquiring an asset, getting the tax deductions, the incredible tax deductions that you can get from commercial property and residential property. And then on top of that, if someone else is paying off that debt for you and the values are going up. So it's just a win-win-win-win-win. And from a social impact perspective, you're providing housing that's needed. So it's really a great opportunity, but you have to look at it not so much as high cash flow. It still exists. You can still get cash flow, but it's really more of using the inflation hedge and knowing that you can, again, borrow money, get it fixed, and yet prices and rents are going to increase over time. So cash flows get better over time, I guess is what I tried to say. So how do you do it? Well, I can tell you right now, my daughter kept saying prices are going to go down. I said, no, they're not, honey. You're 29, you're in the largest group of millennials. There's a whole lot of you looking for homes right now. So the way we were able to win the bid so that she could have a home is come in with a really incredibly strong offer. If you can at all get help from others to acquire property with cash and then refi later, that's one way to win the bid. Come in a little higher and then maybe negotiate down once you're in contract, once you've done the inspections and so forth. But it is tough to find the inventory. It's tough to win the bid. At my company at RealWealth, we have 15 rehab teams. They buy distressed property, fix them up, and then resell to investors. So we have relationships and we're able to still get inventory for investors, but it's dwindling. It's hard to get. We also have relationships with builders to help us build inventory to sell to investors, and that's getting harder too.
We'll be right back after a brief announcement. Are you a busy professional, passionate about the work of your calling, yet realize that even though you love what you are doing, you're exchanging your time for money? You know that if you were to lose the ability to exchange time for money, your financial well-being will be in jeopardy. If you can relate, I have great news. Steed Tucker Capital is an investment company designed for professionals to develop financial independence built on solid passive real estate investments. Remove the anxiety of an uncertain financial future and go to steedtucker.com. Get your free one-page 10-step guide to passive real estate investing. That's ground-up development you're talking about?
Mm-hmm. Yes.
Yeah, and it's just as difficult as finding below value existing properties for rehab.
Yeah, there's always opportunity, right? There's always opportunity. There was let me put it this way. I've been in the news business all my life. I graduated in broadcast communication arts many years ago, and then worked at CNN and ABC7 and Fox News. And I've been a regular guest expert on many news channels since then. And I can tell you that if it bleeds, it leads. Journalists always want to get the attention-grabbing headlines. So there's been a lot of attention-grabbing headlines that there were going to be all these forbearances that were going to turn into 5 million foreclosures or something like that. And people have been sitting around waiting for those. They haven't shown up. Those forbearances, which is basically where people didn't have to pay their mortgage during the pandemic. They could postpone that and not have it hurt their credit. Well, many of the banks learned from the Great Recession that foreclosing was not a great option for the banks. They were basically not getting very much value for the foreclosure. So they kind of learned not to do that. And instead they learned to modify those loans, which is what I predicted when the forbearances started. I said, they're just going to say, due to no fault of your own, you've lost your job. You were forced out of your job. We're not going to make you pay when you're not allowed to go to work. And then I just figured that those forbearances, all those payments would just go to the end of the loan. And that's what's happening. They're getting modified. They're getting, just extended. So that foreclosure crisis is just not happening. What we are going to see is an uptick in foreclosures that were already sort of in process before the moratoriums. But, a lot of these headlines that there was going to be, all the eviction moratorium would mean there'd be a flood of evictions when that was over. No, none of that happened. There's going to be a little bit more inventory, but it'll be gobbled up so quickly from all the desperate people looking for it. Yeah, it's not going to be what investors are hoping for, which is a sudden crash like 2009. I know y'all are waiting for that. It's not going to happen. It's not going to happen. I'm sorry.
Yes, blood in the water can excite investors for sure. But there's a lot of fallout for that. It would be much better to have things modulated, really.
Yeah.
And truly.
Yeah, you don't want everybody in their homes just so you can get a deal.
Yeah, absolutely. Well, tell us a little bit about quantum easing and what it is, and first of all, and then what effect is that going to have upon investments?
Yeah, quantitative easing is just a fancy way of saying we push a button and print more money and circulate more money. It is a fallback that the Federal Reserve has started to depend on after the complete mess up with in 2008 when the loans came due and people couldn't pay them and those crazy loans that were given out. The way to fix that problem was to print more money because the banks came to they were just failing. And so the Fed just printed a bunch of money to save the banks. We've heard that story. It's an old story, right? But then that became the new way that when politicians want something, they just print more money. So instead of saying we're just printing more money, they're calling it quantitative easing so that nobody knows what they're doing. But that's what they're doing. And that is, very good for people who own assets. If you own stocks, you own real estate, those assets go up in value because there's just more money circulating. Like I said on the board game, just more money to play with, but the same number of assets for the most part, not completely. So quantitative easing, it's a tool that our central bank uses to keep the economy going. But they've never done it quite like this before, not to this amount, not to where, the government can say, we're just going to keep creating trillions of dollars of this quantitative easing every year to pay for things that we want and need, like infrastructure. No one wants to argue with that. We need infrastructure. But how do you pay for it? You just create more money. Well, what is that going to do? Deflates the dollar. And so it hurts people who don't own assets. And that's what's sad. And that's why I'm on shows like this and why you're doing shows like this, to tell people you're going to get left behind. Because if you don't own assets that inflate with all this money, then you're stuck just paying more. If you're a renter, you're going to be stuck paying more all the time, rather than be in a mortgage with a fixed payment for 30 years, right? In 30 years, imagine what the renter is going to be paying in rent versus the owner who's on the same fixed payment and now has their house paid off. Those are two scenarios that if you're 30 years old today, 60 years old in 30 years, one person now has a house that's completely inflated, probably tripled in value and no payment. And then you've got the renter whose rent has probably tripled, if not more, and they have nothing. They don't have that house. So this is the issue. This is the concern. The gap is going to get wider. And yet there's opportunity for almost anyone to be able to acquire these assets if you know how. You've got to have good credit. You've got to have a 2-year job history. But you can literally buy a $100,000 property at this point somewhere in the country and hold it as an investment property, fix it up a little, refi, get all your money out and go do it again. You can get 10 of those loans. Like anyone can do it. You can get a fourplex and live in one unit, rent the other 3 units out. You can do it with an FHA loan, 3% down, and live there for free and have the other tenants pay your loan off. Like there's ways to get in with very little money. You can wholesale, you just have to learn and know. If you have no money at all, you can find people who have money and they're worried. They want it secured to real estate, and you let them be your lender and keep them safe by securing them like a lender to the property, and you take care of it, fix it, and then everybody profits. So don't give up.
Very excellent advice. And I like what you said about the fact that you have to have assets. And particularly in times of inflation, if you don't have the assets, you are going to be left behind. And I just hope all young people out there hear this message. A brand new spanking automobile is not an asset.
That's right.
It is a good way to drain your pocketbook, but it will not help you particularly in times of inflation.
Yeah, I'd like to speak to that if you don't mind. My daughter came to me at 24. She was 24 years old. She had graduated and had been working for about 2 years at her job, making less than $30,000 a year. And she happened to live in Northern California where prices were pretty cheap. And she said, Mom, I'm going to go get a new car. And she had a car that worked, but she just wanted a new car. The old car was old, but it worked. And I said, oh, wait, before you go buy that car and you take on a $400 or $500 a month payment that has now dramatically affected your debt to income ratios, just go talk to a lender. Just go find out if you qualify for a house instead of a car. And she's like, Mom, I'm 24. I said, I don't care. You're living in an apartment. Maybe you could live in a house or a condo that you own and pay the same. So she went to the lender. Turns out she could qualify for a $300,000 house. And it turns out that was available in Chico, California at the time. So she actually bought a fixer-upper for $250 and ended up just selling it a couple of years later for $350. So she made $100,000 and still driving the old car. Now, if she bought the car, she would have a car that was worth probably half what she paid because it does depreciate. And instead, she ended up living basically for several years, not paying, basically living for free and making $100,000.
Absolutely. And the other thing I tell these young people who are so eager to go out there and get a car is, you already mentioned what it does to the debt to ratio, whereas if you can qualify at first, you can qualify for a home before purchasing the car and go out and do that, because that debt to ratio is going to knock you out of the house and you may end up with a car but no asset. But if you do it the other way around and you get the house, chances are you can qualify for an automobile loan after you get the car, but not vice versa.
Yeah, right. Buy the house first.
Yep.
Or the condo or the townhouse, whatever you can get into. And you don't have to live there forever. You can get it as a primary residence, live there for a year, and then rent it out.
Yep.
Go live somewhere else.
Absolutely. All kinds of ways, as you had mentioned earlier. And none of these ways are really all that complicated. It's just learning a little bit of information and learning how to apply the different strategies. It may not work where you live. Maybe you need to purchase where you don't live. And that is an option today, too, that hasn't always been there. But with the internet and real estate becoming more available through the internet, there really are more options for investing outside of where it is that you live. Well, Kathy, tell us how to get in touch with you and what is it you have to offer?
Yes, you can reach us at RealWealthNetwork.com. Real like real estate, wealth as in your money, and network as in the network of resources we have to help you. So RealWealthNetwork.com, it's free to join. And when you're there, you'll get lots of data and information on the best places to invest. And you'll get referrals to the teams that we've worked with for 20 years who specialize in helping investors find rental properties and manage them. So they help investors find the properties, they fix them up for them, and they manage them. So it's kind of done for you. And they have a great track record with our 60,000 investors. So, and then just tons of it. We have over 500 webinars, educational webinars on how to get the tax benefits, asset protection, how to get the best loans. That's all there for free. We are a broker. We have a broker to broker relationship. So when we make a referral, we get part of the commission. It's pretty simple. There's no trick to it. And then you can also speak with an investment counselor to help you, figure out what's the right choice for you. So, I've got a dog. I apologize. We lost power and I am doing this interview from my phone. But that's the struggles, the trials of living in California. We're always on these,
Always nice to have a dog with you wherever you go. Well, Kathy, it's been a delight having you. I have one last question. It's kind of a multi-layered question, and that is, share with us one of your most difficult setbacks in life, and how did you come through that time, and what did you learn from that experience?
I got caught in the mess of the Great Recession. I was just knowledgeable enough to be dangerous. That's all I can say. I hadn't been through a down cycle myself. I had seen other people, but not myself. So I was a little aggressive. Back then, you could get unlimited number of investor loans with no money down and barely any documentation for anything. Mm-hmm. So why wouldn't you, right? So I got a little addicted. We bought lots of properties. We did really, really well in Texas. I bought brand new homes and multifamilies for cheap. And they cash flowed and they were great properties. But then I got a little cocky and we bought a few properties in Boise, Idaho. It's a great market now. It only had 2 major employers back then. So when the market fell, it hit hard in Boise. And then we had 3 homes under construction in Tennessee at the time. And the banks failed and they couldn't be completed. And so we lost all our money in those. It was a really tough time. So what I learned from that is to underwrite really carefully, to always expect the unexpected, and have plenty of cash reserves. It's okay to be leveraged on properties that cash flow, that pay for themselves. But a lot of people at that time were buying properties that were negative cash flow, and you can't do that for very long. That'll drain you. So as long as you can break even and cover your costs, or better yet, cash flow, and have plenty of reserves, you can get through hard times. So that was the big lesson: is make sure you're cash flow positive and make sure you have reserves and that your underwriting's excellent.
Very, very good advice. Not fun lessons to learn, but sometimes the worst times are the best times in terms of at least learning.
Yeah.
Well, Kathy, it's been a pleasure. Wonderful meeting you, and thanks for being on the show today.
Thank you.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.